All right. Put you down a little bit. So we've got two approaches to measuring GDP. Got one more thing that I wanted to show. We'll see. We might get there. All right. So two approaches. Once that screen was down, it's a little bit of a production to get it back up. I was thinking that would have been cool to do that at this point, but we can. Two approaches to measuring GDP, gross domestic product. We've got two ways of keeping the books because of spending equaling income. So the first one we're going to look at is the expenditure approach. The expenditure approach to measuring GDP. And this is the one that just simply compartmentalizes spending into those four components. All right. So we've got total spending grouped into four categories. Category number one is consumption with a C. And this is just spending by households. Spending by households on new goods and services or final goods and services. This category makes up about 70% of GDP. Number two, investment. Investment is spending by firms on new capital. And remember, capital is machines, buildings, etc. So spending by firms on new capital and inventory. Inventory of unsold goods. So this little category helps capture that part where it was the dollar GDP was the dollar value of all final goods and services produced within a nation's boundaries over the course of the year. Some of those final goods and services were purchased. They fall into consumption. Some of those goods were not purchased yet, but they're just on the shelves of Walmart, right? So that inventory number is captured then in the investment category. So we've still captured the production, the value add that's went on. All right, another important category with investment is the purchase of new homes by households. Purchase of brand new homes, new construction homes, brand new homes by households. So this is new construction. Remember, we don't want to double count because a used home might have been sold a couple times within a year, so that wouldn't be fair. But we want to add in the new construction homes. If you bought a $220,000 house and it was brand new construction, we're going to throw that into the investment category. So they decided that that was more appropriate rather than lumping it over here, since that's kind of a big ticket item for any household, right? Biggest purchase most households ever make. We're going to treat that in this investment category as well. Okay, number three. Oh, and then I got the I there. Okay. Government spending.
Question, Ben?
Yes?
What about like remodels?
The remodeling work would have been captured in the bill that you paid the contractor. Yep. So that would fall into that category. It would not, in the grand scope of things, it wouldn't end up falling into this category on the accounting. Okay, government spending. That one's pretty self-explanatory. All the money that the government spends. And then finally, number 4, net exports. Whenever we see that word net, it usually means that the word that follows it, something's been subtracted from, right? So if you think about your net income, what have you taken into account most likely? Your taxes. So it's your income after tax, right? So you got your gross income, you got your net income. So that's typically the way these things work. When you see the net term, the word that follows it, something's been subtracted from it, typically. All right, so what we've subtracted from the value of exports here is what we've imported. So for net exports, what I'm going to call big X, big X net exports is equal to our exports minus our imports. The dollar value of what we sold to the rest of the world minus what we bought from the rest of the world. And the only thing you might want to kind of add in is that this can be negative, and it is for the United States. So this is negative. This is a negative number for the USA. This year and for about the last 40 years. I can't remember when the last time we actually had a trade surplus, but it's been a long, 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 long time. Okay. So our equation, putting our equation goggles on, looks like this. GDP is equal to C plus I plus G plus X. We just add them up. And that's the expenditure approach to measuring GDP. Now, I want to add one more level of detail that'll help us later on when we think about it, I hope. Within these categories, there's a whole bunch of households, of course, spending money. So we can also think about this as the sum of all individual consumers consuming, the sum of all consumption, plus the sum of all investment. There's lots of firms. I'm using kind of sloppy shorthand right now. I'll skip the little I equals 1 to n firm, all that. So this is the summation notation, just to kind of remember that we're adding up a bunch of individual activity, plus the sum of a whole bunch of government agencies that they spent money on stuff, and then plus this net sum of net export activity. And if we start to break that down further, for GDP, we really could go down to the microest level. And so we could say, well, Russ bought 1 Mountain Dew, so the price of a Mountain Dew, times the quantity of Mountain Dews that Russ bought, that's Russ's spending on consumption of Mountain Dew, plus the price of a chicken wing times the quantity of a chicken wing, right? Plus the price of a Redbox DVD times the quantity of DVDs that were purchased. Dot, 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 dot. Yeah, we got chicken wings, Mountain Dew, and DVDs. Heck of a Friday night, right? And that's what this little summation notation is. So kind of if we really think about the dollar value of all final goods and services produced within the nation's boundary, it all collapses down to this expression the price times the quantity of the I equals 1 to N items that were produced in the United States. There was millions of items. And so there's a little formula that adds up all of the spending on all final goods and services produced within the nation's boundaries over the course of the year. All captured in this little guy right here. And these two things are one and the same. So I just wanted to bridge that gap for you, that our cigarettes thing up here at kind of this macro lofty level is all tied down to a very micro level of you and some Mountain Dew and some chicken wings and a DVD. Okay? That's the connection. All right, questions or comments there? All right, how about the income approach? With the income approach to measuring GDP, we're going to add up all of our incomes. So we're going to put a little more detail on this. But we saw in the flows that every dollar gets mapped to some resource being used for it. And so number 2 is the income approach to measuring GDP. And this is simply the sum of all income earned. Through the production of goods and services. So, national a little more detail what these are. National income is composed of employee compensation, so compensation to employees. That's a biggie. Lots of workers out there, even though unemployment's higher than we want it to be, there's a lot of money being made by employees. Net money that you earn on some of your investments or savings, plus rent income. If you own a rental property or a commercial property, somebody's paying you rent, there's a building in play, so rent is the return to the bucket of land that we have, or the building that's on it, or the combination of the two. Plus corporate profits. Profits from corporations. Corporations are a legally defined entity that can generate a tax bill. They can generate income. Of course, they're owned by the shareholders. How many of you heard of the double taxation from corporations, or that goes on with corporations? Double taxation. They get hit with a double whammy, and so over time this is an issue sometimes that gets brought up. Basically, the corporation earns a profit. Let's just say a corporation earns a profit of $1,000, and they get taxed $100, right? So that the leftover profit is now $900. That $900 then goes to the shareholders who own the corporation, and Uncle Sam wants to tax them on it too. So Uncle Sam taxes the corporation at the corporate level, and then hits the owners of the corporation again. So that's the double taxation with corporations. All right. So anyway, that's something that's out there that needs to be dealt with. And then we've got small business owners, just in general called proprietors' income. proprietor's income. Sole proprietors, small business, LLC owners, basically non-corporate entities fall into a different category. They don't have that double taxation, by the way. How many of you have some parents or relatives that own a limited liability company, an LLC? Quite a few of you, right? LLCs. So that would fall into this category, non-corporate. It's still a business entity, but it gets treated differently for tax purposes. Okay, so there's more detail underneath this that we're not going to get into, but this is enough to at least get you thinking, get the juices flowing about where income is generated. And in reality, national income, but, let's put a big but up here. But national income technically does not equal GDP. So just to say that I didn't lie to you, we got to do a couple accounting maneuvers. And this is boring, and I don't really like it either, but I don't want you guys to sue me later that I said income was equal to spending. So here we go. If we take, so we need some adjustments. We need some adjustments to make them equal. We need some adjustments to make them equal. And here they are. If we take GDP minus what's called a capital consumption allowance, which is really just depreciation. I almost should just put depreciation up there, but it is called a couple things. We get what's called net domestic product, NDP. If we take NDP and we add net foreign factor income, net foreign factor income. Net foreign factor income. Remember the whole thing of the dollar value of all final goods and services produced within the nation's boundary? Had the Japanese and the Germans and some other folks that made stuff in our nation. Do we want to include them in with our income? Not for this purpose, right? We're trying to get the income of Americans, and so we need to adjust for that. And so that's part of what we're doing here is we're netting that out because there's Americans making Fords in Germany, but there's Japanese making Toyotas in the United States. We're going to net those two out. So we're going to adjust for foreign production in our nation and also production by Americans in the rest of the world with that number there. Almost done. Subtract off some indirect business taxes. These are little luxury taxes and a few little miscellaneous taxes. And we get national income. Phew! Done with the accounting. I promise we won't do much more accounting. So the only thing that I might want you to highlight from this equation is what I just said. Net foreign factor income is the adjustment for, I'll just leave it kind of loose here, Fords made in Germany and Toyotas made in the USA. Then we've got Americans' income equal to the amount of stuff that we made within our nation's boundaries. And all of these are fairly small adjustments. So at the end of the day, for most purposes that we'll do for the rest of the semester, spending equals income. Those are pretty much one and the same. All right, questions or comments there? All right. So we talked about some problems with GDP last time. What were some of the issues that we had with GDP? That as far as, and let me give you a little bit more on that. What were some of the problems with GDP in that it didn't always reflect all of the economic activity that goes on? What were some things that were missing?
The under the table.
Under the table stuff, so it was missing all the crime. But remember, drug dealers have to go buy toilet paper at Walmart too. So there's a lot of activity going on that's not getting part of it. So that's missing that activity. Parenting, so we talked about if you stay at home with your kids or making other household decisions, so all household work in general, raking your lawn, mowing, anything you do yourself doesn't show up on the books. Okay, anything else? Volunteer work was a big thing. Again, a lot of work going on that doesn't have a wage associated with it, so it's not going to show up in any of these places. So the level of economic activity doesn't really get reflected very well in those numbers. There's a potentially even, and a lot of those problems don't have, I guess, easy solutions to. Do you think it would be easy to measure how much goes under the table or how much housework? You know, should the government require us to report, well, how many times did you wash dishes this week? All right. Nearly impossible to really estimate that, but that never stops economists. There's economists out there that try to estimate that level of activity, but it's very difficult to measure. All right, so a larger issue that we do actually have a good answer for is the price effect. If we look at that equation that I erased, what do we care more about, the P or the Q? What do we care more about, the P or the Q? So GDP equals the sum of price times quantity of all the stuff that we make. What do we care more about, the P or the Q for well-being, for how well we are, for how happy we are, whatever? The Q, right? So we care about the P. Often we get hung up on the P, though, right? We're always thinking dollars, and because we don't really think that much about it, it's just more important, well, how much money do you got on you? Well, I got this much. Okay, well, we know we can do this. So it's not the money that you care about, it's what the money buys. So when we look at this, how does GDP increase over time? Question mark. If you all believe me that GDP is this, with all the stuff, all the foundation that we've made, what is the only way that GDP can go up? And there's multiple ways, but if we look at this equation, having our equation goggles on, how does GDP go up next year? Buy more stuff? Look at this equation. Let the equation talk to you. Tell me from this equation, interpretation of the equation, in order for GDP to be higher next year, what are some scenarios of what must have happened over here? Price went up, or quantity, or both. Or what else? There's a couple other scenarios.
One could go a little higher and one could go a little lower.
Good. One could go higher by more than the other one went lower, so that the net effect was going up, right? If they both go down, GDP is definitely going down. If one goes down by a lot more than the other one went up, GDP is going down. So these are the only things that can happen. Now, for well-being, though, which one do we care about again? The Q. If this goes up, that doesn't necessarily do anything for us. So if I have the average price of things is $100, and I have two $100 items. Give me a $100 item. Drawing a blank here. A bike, some shoes. Ooh, those are some nice shoes. All right, so let me go with the shoes, because that's kind of a cheap bike. Nice shoes, but cheap bike. All right, so we've got 2 pairs of shoes at $100. If next year shoes are 120, what is GDP? 240. It was 200. Are you better off? You still got 2 shoes. You're not any better off, right? Maybe shoes is a bad example because usually shoes last longer than a year. Maybe we could have made this beer, would have been a little more fun. So are you better off? No. So the price going up does nothing for you if we just care about the Q. So this is an important issue that we need to figure out. So how does GDP increase over time? So number one, there's an increase in price and an increase in quantity. Number two, there's an increase in price and a decrease in quantity, but the percentage change in price is greater than the percentage change in quantity. So basically the up effect outweighed the down effect. Number three, there was a decrease in price and an increase in quantity, but the percentage change in quantity exceeded the percentage change in price. All right. The problem is we only care about Q. That's the one we get happy with. So what we want to do is come up with a way to filter out that price effect. So we're going to do a little example. Start a new column if you haven't on it, and we're going to make about, I don't know, 7 columns worth of data as we work through this little piece here. So we've got one column is time. Year 2011, 2012, 2013, 14, 15, 16. We've got the price of good 1, and it runs 7, 9, 11, 12, 13, 13. We've got the quantity of good 1, and it's at 25, 20, goes up to 30, back down to 23, 24, 24. We've got a second good. We're just going to do 2 goods in the economy just to get a feel for this. We got a second good that's priced at $8. Goes up to 9, stays at 9, jumps to 10, goes to 11, and ends at 13. And then the quantity of good 2 starts at 20, rises to 25, stays at 25, jumps up to 26, stays at 26, and goes up to 27. All right, so I'm going to walk down the room here. You guys are group 1, 2, 3, 4, 5, 6, 1, 2. Go ahead and calculate GDP. I just gave you 1, 2, 3, 4, 5, 6. As soon as you get an answer, give me what it is so I can fill in this table. I do not have the answers any longer because I had a little bit of a starter, but I made up the numbers as I went. So you're following this formula. You've got 2 goods only in the economy. GDP of each year, so 1, 2, 3, whatever I listed you got it? The answer? As soon as you get an answer, tell me what it is so I can start filling in the table. 536 is 4. And make sure you're double checking so that everybody's calculating so we get...
Yeah, we just do 1. 335 for 1.
335 for 1. You guys got 2? 305? Just shout out a number. If you're wrong, it's no big deal. I just want to fill in the table here. Number 3? 555. Number 5? 598. And number 6. Still figuring? Anybody number 6? How much? 396. If somebody, a couple other people can verify that. Make sure we got the right numbers. You got 408 for 2?
405.
405 for 2? Okay. So there might be a little bit of rounding error. How many other people for number 2? 405 it is. Okay, 405.
6 can't be right.
6 can't be right? Is 6? 663. Do I have a second for 663 for 6? Okay, 663.
Yeah. We can't go down when it moves.
Yeah, if you start to look, that probably was kind of surprising when I wrote it, but that's all right. All right, we got a good table now. I don't have the answer, so I'm relying on you guys. All right. So, how has the economy fared? Good or bad? Good. So what was the level of growth over time? So if you were to, over the 6-year time frame, how would you calculate the amount of growth in GDP? What's that formula? Year 6 minus year 1. Need a little more than that if we think about growth rates. So from 1 to 6 equals, what do we got? 663 minus 335 divided by percentage change in a variable. New number minus the old number divided by the old number. X1 minus X naught divided by X naught. However you want to do it. I like to think of new number minus the old number divided by the old number. So over this time frame, what does this number shake out to be? It's going to be pretty big. 98%. It looks like it about doubled, so I'm okay with that. 98, I see some head shaking. Give me exactly what it is with to two decimals. 97.9%. Well, that's pretty nice growth of the economy. Now, let's have prices over time.
They went up.
They went up. So part of that huge amount of growth that went on was due to increases in prices as well as quantities. What do we care about? Quantities. So how could we fix that? What could we do to these numbers? I'd like to hear some ideas on what we could do to come up with the growth in quantity rather than the growth of price and quantity combined together, all mishmashed up. You might have to lean on some of your mathematical brains. What do you got? Price per unit. What do you mean? How do you want to do it for this good, for instance? What's causing the problem? So you want to do, so we only got two goods. Here's how the price has changed over time. What do we want to do? I know I got a few math people in here. Might lean on you a little harder.
We just want quantity, right?
We just want quantity.
Couldn't we just divide by sigma p?
I don't know what a sigma p is.
In other words, just if GDP is sigma p times q, then we just get rid of the sum of p by dividing it out to the final product.
How can we get rid of the p? That's what we need to do, is get rid of the p somehow. Now, can we just add these up, by the way? Can I take 25 plus 20 is 45? 20 plus 25 equals 45? And 10? No, we can't add apples and oranges. That makes no sense whatsoever. So we have to keep the dollars in there somehow. Brandon, did you have an idea?
I was just going to average them up and find the one price.
Average what? Average what up?
All 6 prices.
All right, if you take all 6 prices and average them, that would do it. That would work. That's not the way it's actually done, but that would be one solution. Okay, so one solution is to average them all. That would work. What's done is to just fix a year's prices with it, calling it a base year. And so we can pick any one of these years and kind of freeze the price at that year. So if we freeze prices at 12 and 10, and then recalculate all the numbers according to that base year. We'll pick up there on Monday.